Good morning, everybody. Hello. Welcome to the Flow Show. Hope you're doing fine and dandy. Sorry, I didn't think my mic was working there. Morning, Kay. You okay, mate?
Yeah, good morning, Ryan. Good morning, everybody. Thank God it is Friday.
Oof. Yes, and some. Another wacky week in FX markets. And I just want to kick off with what you can see on the screen there. If you don't know, we've launched a mentoring program where you can get one-on-one coaching from a lot of the team here at ForexAnalytix, including myself and the good K-Man. So if you want to check that out there, you can see the website, trader-coach.com. Have a look at that. If you do need any help with your training or trading, then check out those sessions there. We cover a wide range of topics, from technicals to fundamentals, you name it, we cover it. So have a look at that there. But otherwise, we shall crack on because lots to go through. Right, where should we start? We've had Suzuki up daily now, them not in Japan popping up. He says the weak yen has pros and cons. As we've been mentioning, there's always two sides to the weakening strength FX story. Says we are analysing the background of what is driving FX moves. And an interesting comment saying there is a chance FX will be discussed at next week's G20 meeting. Now, Japan never asks for permission before they intervene, but they do have discussions a lot with other central banks and other finance ministers and whatnot. So I don't think this is a precursor to intervention, but I wouldn't be surprised if we start seeing headlines saying something like intervention may come after a G20 finance ministers meeting or some such. So it's more a speculation thing. I still think you've got to watch for weekend risk or early week risk of intervention early in markets. What is Sunday night here, Monday in Asia. So be careful with yen trades if you're holding them over the weekend. You may want to think about getting out on a Friday and getting back in if nothing's happened untoward the new week. Just reduce your risk. Anything to make of that G20 comment, Kay?
Well, could be interpreted both ways, right? Could be that we get some sort of confirmation that the others agree with what Japan wants to do, like that is not let the yen weaken too much further. But on the other hand, it can tell the markets today that they won't do anything until then. So the G20 finance ministers meeting is next week, Washington, on the 18th. Is it giving the traders, speculators another small week to try and put it higher? That's the other side of the medal, right? Well, personally, well, as everybody knows in the room as well, I'm running it just through options, and that's working pretty all right. Yeah, I'm not tempted to go completely hedged over the weekend, although it may be wise. It'll depend where the rest of the dollars end up today. But if we see all dollars getting bought, right? Particularly against the euro, sterling is now trying to break sub 125 as well. Other dollars are also pretty big again. The Aussie dollar is nearing the 65, the figure zone, although 64.80 is the bigger one. So if the rest of the dollars is bid, the issue with interventions, which is always going to be the case in such a scenario, is that if they intervene, let's say on Monday morning or so, they are going to run in people who want to buy dollars on big drops. So because the rest of the dollars are so big. So and another observation or another thought on the back of what they said about the G20, I do not think that any other country, albeit I don't know about Brazil also, who are also part of that G20, But the majors, I don't think that anyone is ready to curb any of this dollar strength. So the thought for me is that if they get the green light to do whatever they want, whenever they want, they're still going to be on their own. It's not going to be a joint intervention. We are not talking about anything anywhere close to a Plaza or a Louvre Court. I think Plaza was the one where the dollar got hammered, right? We are nowhere near that. There's not going to be a joint intervention. So yeah, I think there's always the risk. I mean, especially I wouldn't say today 100%, although everything is possible, but I would say with every 50 to 100 points that dollar yen goes up, the risk will increase. That's a fact. Are we ready for an intervention? I don't know, because apart from that line, all the rest is pretty much the same. In touch with Canada, they are ready, high sense of urgency, checking on whether it's a speculation or not. Those lines haven't changed even since when we were sub 152. So yeah, I mean, everything is possible, but it may be that we just have to wait until next week when they will meet in Washington, or I don't know, perhaps they're doing it on a virtual meeting or so. But yeah, we may be in for another week of patience there.
Yeah, exactly. Just watch out for that speculation. Right, coming over to a bit of data. UK GDP this morning, just the monthly numbers. Coming in as expected for February, 0.1%. So still keeping a positive there, less negative on the year. Has it got it there? The 3-month rolling? Yeah, 3-month rolling coming in a bit better. This is sort of a partial quarterly type number, coming in at 0.2. So as you can see there, green shoots still appearing. Manufacturing, industrial production as well, also coming in positive for February too. And a better trade deficit as well, as you can see there. So yeah, things are looking green shootish. Not that you know it by the pound at the moment, but obviously under that heavy dollar influence. BOE's green, talking again, saying that wage growth is still far too high. The UK has shown signs of coming out of recession, sees inflation coming down and the jobs market strong. Says UK firms may be still hoarding labour after COVID. She expects the inflation to hit target in May, but only briefly, and says easing too early risks future tightening. On the expectation front, gold is now forecast the BOE to cut rates only 4 times this year versus 5 times they expected previously. They expect the BOE to slow to a quarterly pace of cuts, so every quarter from Q4 onwards. Riksbanks Jensen has said that a threat to a May cut is mainly from other central banks. So much for saying they're all independent of the Fed. We know who they're poking at with that comment. ECB, they kept rates unchanged, kept everything unchanged. It was a pretty dull affair. The only change in the statement was a move to include explicit rate cut language. In the prior statements, it had all been about rates are restrictive and restrictive language. They actually then put in a whole segment in the statement to say that if things go their way, then they will look at reducing the rate. So it was the first time it's actually appeared in the statement. That was about the only, if you like, change of note there. The guard presser, what an absolute shit show that was. Probably the worst press conference I've ever seen from an ECB ever. No real big comments coming out of that that we haven't really heard about before. Though they did say they won't wait until, or Lagarde said they won't wait until each item in inflation is back at 2%. Obviously, since then, we've had a ton of ECB members let off the leash, busting down the stable door to say their piece. Muller said slow inflation boosts chances of a June cut. Stornow says now is the time to diverge from the Fed and reiterates his call for 4 cuts this year. Kazakhs says we'll cut in June if nothing surprising happens. He's one of the big hawks over there as well. Then we've got the old sources pieces to go through as well. One lot said that ECB policymakers still expect to cut interest rates in June. No real change on that one. They said policy doves still eye cuts in June and July, even amid a benign labour market. Another sources piece said some policymakers make a case for a July pause on the risks from strong US inflation, energy and geopolitics. And another source piece said a handful of ECB officials needed extra convincing to back a hold at this meeting. So keeping the doves in check. Kay, you can do the review of the ECB yesterday, mate.
I have very little to say about the ECB press conference. I'm trying to talk at the same speed that Lagarde was talking yesterday.
Oh, yeah, she was slow yesterday, wasn't she?
That was an absolute, one of the worst we've ever had. That is typical because I don't know if everybody knows that, but she's a lawyer by academic scholarship. She's a lawyer, and yesterday she tried to her utmost best to come over as a lawyer who has absolutely nothing to say, but still needs to fill in an hour of a press conference. So that was about it, and even the Q&A. I mean. I think the reporters got like it got absolutely heavily impacted by the way she was bringing it over, because they were absolutely lousy as well. Yesterday, it was even worse than she was. It was an absolute crazy one. There's absolutely nothing to say. The most interesting part of it is. Perhaps the one line that you mentioned is that some of the doves needed convincing to keep the rates on hold. I think we can name a few of them, like Centennial, Stornaras, the COS, possibly Villeroy as well. They must have said that they knew enough and it was time to cut. They have been kept in check. And then the quarter hawkish bit perhaps would be later on the usual sources piece coming out saying that July is not a done thing, because that was what the market kind of was waiting for, to see if there would be a possibility to have a June and a July cut, but we didn't get it. And then the euro just caught a little bit when that came out, and that was also right after the 30-year Treasury auction. But I think the message of the ECB is that likely cut in June, because the hawks won't be able to keep the doves in check then. And also we've heard from the hawks that they are also themselves ready to cut in June. So that is a done thing. So I guess I think that's why, barring the dollar being strong against all the rest, the euro is also coming off on its own. If you look even at crosses versus euro crosses are on the defensive as well. That puts us in a scenario where they are possibly cutting before the Fed, right? Because the Fed is not a done thing now in June. And that's why this euro is heavy, and I think rightfully so. That is just the one message that I got from it.
Yeah, I think that's the case now. You know, June is pretty much signed, sealed, and delivered, barring any shocks in the data. And really, the trade from here is how much they're going to cut. Are they going to go June, July, which would be a pretty dovish move, unless they said they're cutting June, July, and then holding off for the rest of the year, something like that. So I think that's what we're going to be trading from now on. whether they're going to do that July cut, and then indicate what else they're going to do thereafter. Conversely, if they don't cut again in July, or it's not signed, sealed, and delivered, then that's less dovish, shall we say? But that's where we're at the moment. Euro continuing to break down. Then, as Kay says, you need to, when you look at the crosses, and we're always saying about this, look at the crosses to tell you what the move is. Here is euro yen falling, even while dollar yen's up on its highs. So dollar yen is up on the dollar side of things, not the weak yen side of things, because pretty much all the other yen crosses are dipping. So it's not a yen move you're seeing in dollar yen, it's a dollar move you're seeing in dollar yen. And all the yen crosses are following what their respective majors are doing. As you can see, cable through 125, euro dollar really under the cosh now, breaking through that 107. But we will look at prices in more detail in a moment. There's been, it's a day for forecasts. I'm having one of my bank rants today. I won't bore you with the details. You can check out my post on Twitter. But the ECB survey of professional forecasters, what a joke that is. They have inflation forecast unchanged versus their last quarterly survey. Inflation still seen at 2.4% 2024, 2% 2025. Core inflation unchanged at 2.6 for 2024, 2.1 2025. They have cut their growth outlook for 2024 by a pip to 0.5%, but raised 2025 by a pip to 1.4%. Going back to the data and yesterday's data from the US, PPI number. Well, let's look at jobless claims first. Jobless claims, well, not that anything happened there. Pretty much same old, 211 on the main number. Continued claims 1.8 million, 1.81 million if you like. So nothing of note in that. PPI came in hotter than expected. Well, the year-on-year numbers, there were two that came in hotter than expected and one that came in pretty much unchanged, only bar a revision did it go up. Now, the markets went a bit funny over this one because it saw misses in some of these numbers, like only going up 2.1% instead of 2.2%. But you've got to look at what it actually did do. All of them went up over last month and by quite a chunk. If you look at the main PPI number there. So that's still sticky, hot, inflationary numbers, even if it missed expectations. That's why sometimes you need to make the difference between what was expected and what the overall picture looks like. As you can see there, core PPI came in hotter than expected and up over last month. So that pretty much adds a bit of more fuel to the fire we got from the CPI data, i.e. PPI is not going the right way and thus will come out of inflation, excuse me, further down the line. Fed heads were out. Fed Williams, who's vice chair at the FOMC, said the outlook is uncertain and the Fed must be data dependent. Inflation is moving towards 2% and expects further bumps. He did, though, raise his inflation forecast slightly to 2.25 to 2.5% for this year. Did say recent inflation data has been disappointing. Doesn't know exactly what lies ahead for monetary policy. Says there's no need to change monetary policy in the very near term. Recent setbacks are not a surprise to the Fed and that they will eventually need to cut rates. Repeated that a rate hike was not part of his baseline view of his outlook. Fed Collins said recent data argues against an imminent need to change rate, still expects rate cuts this year, may take more time for the economy to moderate as needed, and economic strength may augur fewer rate cuts. Disinflation likely to continue to be uneven, and the recent inflation hasn't changed the outlook for her. Fed's Barkin said latest inflation data did not boost confidence that disinflation is spreading in the economy. Not yet where we want to be on inflation, but headed in the right direction over a longer time frame. The inflation data raises question if we are seeing a shift in the outlook. That's a repeat of his comments. Kay Williams I don't know. Some took it as being dovish, but there were some hawkish slants to that as well, like us
Yeah.
raising of the inflation forecast.
Yeah, did he do a little bit of a Jay Powell one there, walking both sides of the line? That was the impression that I've got from his speech, and I think because he spoke he spoke once before as well, right? And he seems to have a bit of a tough time to make up his own mind. That is what I got from it, and I actually relatively quickly moved on from him because it didn't really tell me much more. But you're right. Yeah, there was a bit for both in there. I just want to come back on this PPI because I mean it was brought on as a pretty big number yesterday, and I know when the red one came out there on the headline number, the dollar actually got a little sold off, just a little bit. We are talking about pips here, right? It's not like dollar didn't sell off for a big figure or so. But I'm with you on that number. It doesn't absolutely change anything to the picture that we have. And again, I'm saying now, let's take everything together because we're still the start of first half of this month. You have this whole picture of the jobs report, the CPI, and now the PPI. And people are already saying like, yeah, but you know, PCE measures and things. But that we have to wait for the 26th of this month before that comes out, a full 2 weeks from now, right? So in the meantime, we trade with what we have, and with what we have now out of the US, and with how actually even compare the central bank speakers. We are in a scenario where the US is looking much more robust and stickier on inflation than what's happening, for instance, in Europe. Okay, and looking at different at the dollar overall, sterling cable is lower, even though we printed a decent report this morning. But you look back at the GDP, you're printing a 0.1, where the famous Atlanta now Fed or Fed now, whatever forecasts are above 2%. You know, just for comparison, and
Yeah.
that's what I'm looking at. In this whole picture, and what the one central bank may do, like walking both sides of the hawk dovish line, is a little bit sideshow, I'd say right now.
Yeah, very much so. And it's all filtering in. Now, I said I wouldn't mention the forecast, which I won't. What I'll do is, because you all know my thoughts on bank forecasts, that they're all a load of crap, and they couldn't forecast the sun coming up. But they're important to know, the reason being because this is why we're seeing such a shift in the dollar, because the general market is getting more bullish. So I'm just going to put the link to that tweet in there, which goes through all the recent forecast updates, particularly for the Fed. A lot of people going from 4 or 5 cuts beginning this year to 1 cut now this year. And that's the impact we're seeing in markets. You know, euro dollar, we've been in this range for a while. We've been watching this range for a while. We're still in a wider range, you know, down to the 105s, 104.50s, and up to the 111s, 112s. We're still in that wider range, but we're now just breaking out of this tighter range that we've been in. And it's important to note that, because when you get breaks like these of significant levels, it means something is potentially changing, or the market is getting a bit more one-sided over something. We said it would happen. You know, if it was a hot CPI, expect a few days, a few sessions of the dollar being a rally sell, dip buy more than a rally sell. And this is exactly what we're seeing. Now, is it enough to get us all the way back down to 105 or even more? That remains to be seen. But we are moving, and that needs to be taken into careful consideration. Any moves back to 107, if it finds resistance, going to keep the dollar pressure on. So you need to know when we get these goldfish moments that may turn into something longer. We've been hawkish, dovish, you know, every 5 minutes, it seems, throughout this period. You can see up, down, up, down, up, down, up, down, up, down. You need to know when to adjust to that. So if you've been a euro bull, if you've been buying it because you like buying the dips, well, now you need to be careful, because I tried it here, 107, adding into my longs, I got taken out. I did manage to get 20 pips out of it, and then I gave back 26 on the other side. I'm also out of all my longs, all my euro longs. I've been buying, as you know, I bought down here, ran it all the way out there. I've been messing around in the middle, but now I'm out of everything in this break of 107 because I don't want to give back more of what all the rest that I'm holding. So I'm feeling like I should be selling this, but I'm not going to sell it here. So I'm just going to wait and see if what happens if we get any bounces. Next piece of bad US data, we might flip around again and everyone starts ramping up their cut talk and off we go again and we're back at 108. That's the nature of markets at the moment. You can't trust anything for longer than 5 minutes. But just for now, know which way the wind is blowing. Cable, been waiting for quite a while for a test of 125 to go long. Not touching it though, not with the mood the dollar's in. So even though, I've been waiting a good couple of months to have a go at 125, we get there now, the picture's looking different. So I don't want to, I have no conviction or very low conviction in trading it down here. Weeks ago, yeah, would have loved it, even as much as last week, beginning of April, would have loved to trade 125. I was hanging out for it. Now, no, not interested, because I know what mood the dollar is at the moment. As Kay mentioned, Aussie not testing its big level, which is more this 64.80, holding up pretty well. And I think that's probably got a lot to do with gold, which is tapping the 2400 level. This one seemed to be ignoring gold for a long while, but I think the level of the price now, obviously Aussie being a key gold currency, it is really taking a bit more notice of it now, because obviously its higher price is good for the miners over there. Same as Kay mentioned with the rand, another big gold currency. So we are getting some moves. We are still got levels that are still in play. If we break here though, 64.80, then we're probably going to be heading down to 64 pretty quickly, and really undoing this trend. So we've got a lot of that, this undoing of trends that have been running since before the beginning of the year. So be careful. Dollar CAD, another one. Said at the start of this week, if we get the break, if the stars align, hot CPI, a more mildly or dovishly sounding BOC as we got from Macklem, this will probably now significantly break 136, and here we are trading up near 137.50 and looking very strong. So the dollar tide is changing. Maybe now we'll get a move up to the wider range 138s. We've got some decent levels right up these highs here, so this could be a time for a little wander up there, and then we see what we want to do. I don't really think we're going to see massive moves. I can't see 140s, 142s, or up at 146s, because we're still only talking about central banks cutting maybe 200 pips, 250 pips at the very most, just to get to neutral. So that's not really a lot in the scale of things, and they're not cutting because economies are falling off a cliff. They're just bringing rates down to normal, so that shouldn't warrant excess weakness in any currencies or any huge breaks. But the markets will do what the markets will do. Euro sterling, going to be looking at that one maybe for another test of the 85. Will it have the gumption to go through it this time? Obviously, the BOE in question on their cuts as well. We know the ECB are lining it up. The BOE are not as close to lining up a rate cut yet. So we're getting these divergences forming. But will it be enough to bust through 85, 84.80, or will we hold again? These are the levels you want to look at and look to be trading. Something's going to happen if we get there. And there's two ways to play it. You try your longs and you look at shorts if we break it. There's always, don't marry a bias. Just trade what the price action does. Kay, what have you got on your radar in terms of trades?
Yeah, I mean, the dollar for one, well, people know in the room, I'm long dollars. I got a put running, which expires today actually, 107.30. Let me grab that screen. Got a put running in the 107.30 euro dollar. Also, still a bit short cash as well from yesterday after the ECB. I just looking at what Ali put there. Yeah, your take profit in the euro dollar is very reasonable. We have Michigan this afternoon, and although it's a how should I say, a regional number, it's probably tradable on a Friday afternoon. So we probably will look especially at those inflation expectations, because we have seen the sentiment is actually inversely proportional to inversely correlated with the inflation expectations. If the inflation expectation go up, perhaps the sentiment number may be a bit sticky. If in turn we get a better sentiment and a sticky inflation number, the dollar should get another boost to close the week. I don't personally see why we should change anything right now. I don't expect anything shocking to happen. So I guess the rallies up to 107, 107.30 also will find sellers. Opposite side, there's a bit going on here in the 106.40 to 55 zone here. You got that prior low here on the euro dollar. We're right there. I think that's an interesting one. And then we're looking, of course, at what's going to happen around 106, the figure, give and take 5-10 points. Yeah, Gavin, you will. Have you shown it in the room perhaps? Because I've not really got much at 60. Is that a trend line also coming in? Is that this? Yeah, maybe no. That's a bit higher. Anyway, I mean the as we've been saying, the euro dollar daily low 60 must be from here somewhere. November.
Yeah,
Okay.
early Nov, I think.
Sorry.
Early Nov, I think.
Yeah, here this one, right?
Yeah.
Yeah, this one. Okay. Yeah, so I think anything around here, and any bounces here should find sellers. And really, I don't even know if the Michigan has the power to do it unless there is some comments from I don't know, from one or the other ECB bot, and especially I would say Lagarde, if she says like, well, hang on, not too fast. That could do something. Or of course, but that is the outlier and the 1% or 5% chance that we do see an intervention in dollar yen. Then of course all bets are off in the short term in any dollar pair, because then we are going to trade a completely different scenario. Although the finality of everything would still be a stronger dollar, in my opinion, but with an enormous counter wave possibly. So, okay, assuming that everything stays as it is, I think there is a possibility we go and have a look at the 106, and then we revisit again the possibilities, okay? Because we're seeing these higher US yields. We are in this zone here between 455 and 460. There's not too much today unless we get those very sticky Michigan numbers to take it through. So high enough to keep the dollar bid, in my opinion. But is it going to go to really boost the dollar lower than this 106 in the euro dollar? Just to take that example, that's the question. Cable, yeah, cable is now looking a bit fragile. Despite the reasonable numbers we had this morning, and there's a little bit of weight on the euro sterling, and the sterling crosses are holding up relatively okay. But cable in itself, yeah, that's the dollar story. Now we are back below here, the 125. I think there's a bit going on at 124.60, 124. 50, 124, 50, 60 is still worth keeping an eye on. But I suspect that in the current dollar scenario environment, we are going to find offers if we get back up into the 125, 2040 perhaps zone. Okay, if you close the week above 125, 40, 45 though, if I think that could end up being a bit of a fakey and sterling doing well, but that in turn should be led by a sterling move and not really a dollar move. That's my opinion, of course, about what's going on here. Yeah, dollar yen is always the question, right? I've got something here, 143.60, which is an extension of this move from February into March. 153.60 above there, I've got nothing up to 155. I know there's some 154s hanging around, what was it, flag levels or so, but I'm keeping to those ones. And really, trading yen right now is a psychological game, right? So I prefer not to have the cash to worry about in case of an intervention. I'm about 85% hedged on my 150.5 call, which is running into next week. If I see a spike up to that, perhaps even here, 153.60, or for sure somewhere into the 154s ahead of the weekend, I'm going to go fully hedged and then wait to see what happens next week. And as we've been already saying, if nothing happens, we can still re-enter and see what's going to happen next. Okay, in the wider scheme of things, we've got perhaps this one, but that's a really fragile trend line, only 2 touches, which can lead us up into 158 or so. But okay, that's just a theory right now in yen. As I said, I think for me, the yen is rather a psychological trade than really a technical trade. Yep, Aussie as already mentioned. I'm going to plan, because I was saying yesterday to talk about the Japanese investors, but let's plan something for next week, because I do think it's getting interesting. It's getting interesting on the long end as well of the yen curve. And let's talk about those Japanese investors next week at one stage, shall we, Ryan?
Yes, mate.
Yeah,
Yeah.
okay. That'll leave me a little bit of more time to do a bit of research on potential stockpiles or cash piles they are sitting on. I want to look quickly at those Swiss pairs again, because the Euro Swiss is showing weakness. So we've got the ECB in there. We've got, I think, also the market looking at the risk of what's happening in potential intervention risk and still the Middle East risk. So for the time being, I'm actually out of my position. It's been a good run, of course, but I'm out of my position, and the last bit was really not much, barring the carry. But I'm going to just err on the caution side of things in the Swiss right now. I've got a little bit of dollar Swiss left because of the dollar side. But on the crosses, I'm traveling light. I could see this one, sterling Swiss, hold better than Euro Swiss. It's actually doing so. But I'm still very cautious on the positions right now because of this Middle East risk and because also of intervention risk. Because if you intervene in another low yielder, it may have an effect of putting those Swiss pairs a bit lower as well, at least temporary. So for the next days of trading, I'm going to be a bit cautious. And really, for now, I'm through what I really wanted to show. This one is still a bit short. Euro makes, don't change your winning team. We're now under that support trend line here as well. We've got levels up in the 1740s. Then we are looking at low 17s. Could even be that in the long end we are going to move really down to levels that support levels from GFC over whatever European crisis and stuff. Could be, that over the long end we are going down to 16 and a half. It's why not? because we are now entering this bigger traffic zone that we have seen post global financial crisis. So why not, you know? And it pays for the carry. So it's making money without even moving. So that's still a trade I'm happy to be in right now. And with that, Ryan, over to you.
Thank you very much, mate. Just a couple more from me. I'll just grab it quickly.
Oh yeah, I was going to show gold and silver as well.
Okay, well, I can stick it up.
Yeah, go for it.
What was the oh no, it's dollar yen. You showed the extension.
Yeah,
So
gold
yeah,
as
gold.
well. We actually through 2390 was an extension level that I have, but we're already through. Now we have to be careful in gold as well because this thing is moving 20, 30, 40 bucks a day.
Yeah.
$7 on a tech level is not a lot in a metal like gold or silver right now.
Yeah, it is looking very strong, and it's out with the fairies at the moment. You know, there's if I can draw me lines, there's no real text going on here at the moment, apart from looking at you know, just similar story to what we did with the S&P. Just look where the levels are showing up. You know, even really on a short term chart, you know, we've got, you might be able to pick a level there, 2380, pick a level there, 2365 ish. So it's really, you've got to put your levels in and look for where you get tops forming that may give sellers something to get their teeth into, but then see how long it lasts before you get the next breakup. So this is one where you need to draw the picture as it happens to get your levels in, but this is really off to the races. Silver, finally, Kay, you might be getting your decent move in this one. But again, is it being dragged up? You'd like a more fundamental based move, wouldn't you? Where you know that demand is getting up rather than this whatever it is, speculative or, you know, risk
Well, I think
trade
it's
at the moment.
yeah, there's a global phenomenon going on there, and because if you look at for different reasons, the whole commodity sphere is going up, and um, and then gold is going up and silver is being dragged up. Although not all the metals are really enjoying the similar kind of moves. Like I know people talk about palladium and platinum as well, but they don't enjoy a similar kind of move. But yeah, like for instance, copper is going up, which is normally pretty okay for the for an economy. So perhaps silver is going in sympathy as well. The problem is the other side of the equation. If those metals and in gold may be a speculation on geopolitics and problems in the economy. So that doesn't work for silver then, and even copper and other instruments can go higher because of a risk of even in geopolitics as well, because war unfortunately needs commodities as well. But I mean,
Yeah.
that would push silver up, but that doesn't work because it's not good for an economic, from an economic point of view. So there's a lot pushing and pulling right now. But okay, the main event is of course silver. I mean, silver being the poor cousin of gold, as they always say. So there's a partial gold in there, and as the people know in the room, I've been taking partial profits at $28 in silver, and I'm still sitting on some, but I'm going to be very tempted, you know. Print 30, the Reddit high the other day. I might be tempted to just take it and take the money and then see what happens, you know. It's
Yeah.
I don't know.
But
Perhaps I'll take just a slice and let some running just in case this really explodes. Because people are now talking about 45, $50, but you know how this market goes, right?
yeah, I mean, this is looking parabolic. You know, there's no two ways about it. And does that mean you know, it's going to collapse all the way down when it goes? No, but the higher it goes and the sharper it goes, the steeper the pullbacks will be if something hits it that will change it. At the moment, when we're seeing 20, 30, 40 dollar pullbacks, if you're lucky. You know, if we get a headline, Ukraine and Russia are talking, or Iran and Israel are calling off whatever's going on over there, this could dump, you know, $1,000 pretty quickly. It's that everyone's so long, and this is really sharp. You know, as I say, the higher and faster it goes, the greater the pullbacks are likely to be if something changes. So be very careful. If you're long, great, but make sure you lock those stops in behind. And if you're short, you don't want to let this go offside too much or have too wide of stops, because you'll get you keep getting knocked out, just the same as we saw with stocks. And stocks is one I want to touch on quickly, because we are in earnings season now. We're going to start getting the early numbers through today. Kay put a list up in our chat room of who's coming out. The likes of BlackRock, Citi, going to be reporting. So I'm a bit worried about Q1 earnings. I think maybe the banks aren't going to be as rosy as they were before. You know, my thoughts on the auto sector in the US. So I think maybe auto stocks are going to flag some worries, and we'll see if there's any other worries coming in, or if everything's fine and dandy and there's nothing wrong with the economy. But recent data suggests that maybe there are a few little things going on underneath, which could then obviously be a negative for stocks. Now, in this case, you know, I've been drawing this all the way through. On all the other times we've had two holds, looks like a top, then a break, two holds, then a break. This is the only time we've had three holds up near highs, and now we're seeing the biggest downtrend we've seen since the 4800 break, and indeed probably since the move up from late last year. So now this is something that is giving short something to cling on to. As you can see, we're just trending lower in April. Does it mean we've finished with the highs? Not at all. But for now, the sellers are pushing their side of the trade, and the longs are looking a bit more cautious. Went down through this area, which is now washing out a bit. We broke back above. Now we're testing it again. So this level, which was a pretty decent support level, has been crunched. I'm going to be looking at this level down here as my next main level. But overall, whatever happens, you know, look at the trend. The 38.2 of this whole move isn't until 48.30, miles away. So unless we start breaking down these fibs, that will then start to show a trend change. This is all just still short-term stuff going on in here, and it doesn't look weak on a wider picture. It looks weak on an intraday picture, not on a wider picture. So, you know, always make sure you've got your context in terms of, you know, if you're sitting on a 5-minute chart or something, you think, oh, you know, this is looking a bit dodgy. But you come on and look at a daily chart and you think, well, that's not looking dodgy at all. We're still miles and miles up in this trend. But yeah, watch out for those Q1 earnings, because that could be another trigger for sellers to step on the gas pedal a little bit. Right, what a week. Thank you very much, Sir Kay, for all your wonderful insight as usual. And thank you, viewers, for coming and following us at the Flow Show. Hope you had a good week. Please trade safe for the rest of the day and have a wonderful weekend. And we'll catch you all next week. Thank you very much.
Cheers, guys.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.